All right, everyone, so we're going to continue here with Chapter 3, Part 2 on the process of building a daily watch list. Now, this is not something that's probably going to be brand new to you if you've been spending really any amount of time in the chat room, because each morning you get to watch me build my watch list. However, you may have had some questions about why I chose what I chose or how I weight different types of news catalysts, and so this will provide a little more context behind the process of building my watch list. So today I'm going to walk you through the process of building a watch list. How do we find extreme stocks? How do we find the catalyst? How do we understand different types of catalysts? I'll walk you through the process of what I would recommend for a beginner trader in terms of your process of building a watch list. And then we'll talk about trading off the watch list. I will take a moment here just as a tangent to say that, again, I can't say it enough, how much I struggled when I was getting started to find stocks to trade. I struggled. I was trading penny stocks, and then I would trade stocks, shares of companies I knew, like Apple or, whatever. And I didn't know how to find strong stocks to trade. Probably like many of you, had no idea that there were brokers out there that allowed people to day trade with as little as $500. I didn't know about that when I was getting started. We know that those brokers out there are not allowed to advertise to U.S. residents, and so you only hear about them through word of mouth. And so it takes kind of being in a circle of a community of traders to learn some of these things. And when it came to finding the right type of stocks to trade, I struggled with all of these different newsletters out there for penny stocks. Some of them were even premium newsletters that you would pay for, and you'd supposedly get this penny stock alert emailed to you. And that wasn't the ticket, and it took a long time for me to kind of realize each day that there are a small handful of stocks that are really worth trading and watching, that they have something in common, and that there's actually a way to find them before they make the move, and that I could actually be empowered to do that all myself and not depend on someone else. And so you, just in the same way. So the process of building a watch list begins with our gap scanner. Now, while, of course, you could say you're dependent on me for the gap scanner because it's part of our chat room, one of the tools that we offer, you could, if you wanted to, use other services out there if you preferred, if you wanted to be more independent and whatever. But you just have to pay for them because you're getting that market data. So each day begins with a review of our gap scanner. These are the stocks that are gapping up. My minimum threshold for the scanner is 5%. If a stock's not gapping up 5% or more, I don't look at it. It's not even going to show up on the scanner. I believe I may have a minimum volume in there of like 5,000 shares, but I might not. I can't actually remember off the top of my head whether or not we added that. It wouldn't surprise me if we added it, but it also wouldn't surprise me if we didn't, just because, usually if it only has a couple thousand shares of volume, I just kind of overlook it anyways. So today, for instance, this one, HMCO, in fact, is a 58% gap, it says, but has only traded 15,000 shares of volume all day long. So that's one of those ones that, we could look at, and maybe this one as well is like, okay, I guess it's a gapper, but really hasn't done that much. And it looks like the change from the open is change from the close is minus 1%. So kind of a false alert, which sometimes just, might as well just pop this one up and just take a peek at it. So this was HMCO. Let's see. So occasionally we'll see a stock that will have, so like this had, sort of a recent IPO, might have had like a couple of ticks of volume pre-market, but it's basically a no volume stock. So we would disregard that one pretty quickly. All right, so we've got our gap scanner right here. So every day, this is how I start my morning. It's opening the gap scanner and looking at the top of the scan. I can usually tell within just a moment of looking at the scan what kind of day it's going to be. So I'm reviewing the scanner and I'm looking at the top 15 gappers. My process is checking the price, the float, the volume to decide whether or not any of these stocks are really interesting. So today, for instance, I opened up the gap scanner and I was like, nope, I don't like it. So how within seconds could I know that I didn't really like it? Well, number one, the top 5 or 10 gappers, none of them had a float of less than 10 million shares. So float. The first thing I looked at was float. I was like, you know what? I don't see any lower float gappers here. I mean, yes, I see IMTE down here, and I checked. That was one of the first ones I checked because it's a lower price and lower float. But these ones, I was just like, I don't know. Now, yes, this is a 90% gap, so it's definitely worth taking a look at, and I did take a look at it. So my process begins with looking at the float and then looking at the gap. So if we have a day like this where, minus IMTE, this is what our gap scan looks like. And regardless of the gap, I would kind of be a little hesitant. Now, if we have this type of day and the biggest gapper is only 20%, I might not even trade. Because honestly, the biggest gapper on most good days is 50 to 100% or higher. So if the biggest gapper in the entire market was only 20%, that would be that would be pretty weak. Usually we have something better than that. So the first thing I check is the float, then I look at the gap, and then I just, I check the price as well. What kind of prices are we looking at? If all of our gappers are, maybe in this range of super high float, I'm going to be even less interested. 94 cents, I don't care about cheap stocks like that. $21, so I don't really like any of these. And these are several mining companies, which were sort of hot today, silver mining, but I'm not going to go for any of that stuff. So none of these are interesting. If this was the leading gapper here, I would be almost ready to just go back to bed. I think that this also speaks to the fact right now that I was able to say, you know what, I had such a great week last week. If I don't see anything today that looks awesome, I'm not even interested in continuing. Like, I'm not even interested in trading in a choppy market. I'll just wait for the next, really good looking stock. I'm just not even gonna, I'll just wait for the next good one. So, but typically I trade every day, and I did find stuff to trade today. So anyways, that's the beginning. The price, the float, the gap, and then the amount of volume pre-market. That can be an indicator pre-market that we've either got a lot of active pre-market trading or that things are really kind of just very slow out there. Pulling up the chart before even looking at the fundamentals. If I pull up the chart and I see this, I don't even need to check the news catalyst. This chart is bad. It doesn't look good. It's selling off. It's below the volume weight average price. It's not a nice pre-market chart. We'll talk about this in pre-market charts in a lot more detail when we get into the gap and go strategy. But this chart, I don't even need to spend another minute on it. Next one down, LODE. LODE pre-market, okay. The float's 34 million shares. As you can see, I did trade this one today and made 38,000 on it. So, all right, this one, not bad. It does have a bit of a topping tail here up to 3. So what's the catalyst? It's a mining company, and these mining companies are kind of the hot little sector today. So it's a sector-wide catalyst. It's not my favorite, but again, this one did end up providing some opportunities. Next one down, HCO, we'll skip that. VIE, too expensive, not even really worth looking at, although this is a buyout. Horizon Therapeutics to buy VIEA for $53 a share. So when a company gets bought out, from that point forward, its stock is at that price until it gets pulled off the market. So this is not something we would really ever trade, a buyout. PHUN, price is okay, float's a little higher, pre-market chart, is so-so. All right, so if we pull something up like LODE, for instance, and we like the pre-market chart well enough, it looks decent, then it's time to start asking ourselves a little bit about the catalyst. Can we identify the catalyst? So I don't go into the catalyst. I certainly don't go into opening SEC filings or anything like that until first I say that I like the stock, I like the chart, I like the float, the price, and everything else. And now I need to get a little bit more context. Now I need to kind of get some supporting reasons why this is a stock that I can trust and put some money into. So there's many different types of catalysts that we've seen. This isn't necessarily comprehensive of every type of catalyst that exists, but it's a good start. And of course, as you're watching me every morning, you'll see some variations of different catalysts and things like that. We do notice that the market is very, it's cyclical in that we get these little cycles where one sector is really hot, and then that sector sort of dies, and then the next sector is really, really hot, and then that one kind of dies. So in the last 6 months or year, we've had anything related to COVID really, really hot. Previously to that, anything related to Ebola, the Ebola virus, was really, really hot. At one point, anything related to police body cameras was really, really hot due to some of the police shootings. We've had other phases where any stock that is a shipping company is really, really hot. Any stock that is a Chinese company, a Chinese small cap company, really, really hot. Electric vehicles, really, really hot. A special acquisition company, regardless of what they're acquiring, really, really hot. And then maybe a recent IPO, very, very hot, regardless of what the sector was. So we get these little like clusters. A recent reverse split, really, really hot. A cannabis stock sector, really, really hot. And then kind of, things sort of move on to the next thing. So my theory behind this is that initially you have one stock in whatever sector, let's just say a Chinese stock, that makes a 500% move. So because it makes that huge move, traders, they understand that, okay, this was a Chinese stock, which by itself is kind of a catalyst of, I don't know, it's not a very, I don't know what we really call that catalyst. It's a sector type of catalyst. But it's Chinese stock. So then the next stock that's also Chinese, it starts to pop up 30, 40%. All of a sudden people are like, hold up, that last one went up 300%. I'm jumping in this one right now and I'm not waiting. And boom, self-fulfilling prophecy. You have enough people that do that and all of a sudden that next Chinese stock goes. And then the next one goes. And then the next one goes. And then you have a few others that kind of pop up a little and then fade. Now short sellers are kind of catching on and they're saying, wait a second, these ones have no real reason to go up. We're shorting this. These are junky companies. They're coming back down. So then that kind of cycle kind of sort of starts to self-correct a little bit. And then all of a sudden, randomly, you have an electric vehicle stock that goes up 400%. And now all other electric vehicle stocks, start getting that same sympathy momentum where, because that was strong, this was strong. Because this looks like that, so they'll trade similarly. And then that begins that new cycle that goes for a little bit and then starts to peter out. And when it sort of starts to, be on the backside where we're not really seeing them holding up as well, usually we want to be careful about that. We'll start seeing them pop and then immediately reverse and drop. And maybe there's a couple weeks where things are slow and then all of a sudden, off goes one cannabis stock and then that starts the next kind of, cycle. So technical, so I would call that somewhat technical or maybe sector wide, but so the first type of catalyst would be just a technical catalyst, which is essentially that there's no fundamental catalyst, but clearly the stock is moving. So let's just, jump on that momentum and see what it can do. The technical catalyst can be surprisingly strong. So a technical breakout is usually when a stock has been weak for a long time and then suddenly starts to break out from consolidation. It certainly helps if the stock has 140% short interest, because now all of a sudden anyone that's short starts to get squeezed out, and that short squeeze creates that, again, kind of positive feedback loop where to cover a short position, if you've got 10 million shares short of a 50 million share float stock, or let's say you've got 70 million shares short of a 50 million share float stock, you've done what you would think is the impossible and over-shorted the float, which is exactly what happened on GME. Now you start covering. Those are huge buy orders going through. Other traders see that. They smell blood in the water. They see the opportunity. They jump on it. And now you've got this feedback of the more it goes up, the more people have to cover, which means the more it goes up, which means the more other people have to cover, which means the more it goes up. And where does it stop? Nobody knows. So we ride that momentum as it goes up. And we've seen that on not just GME, we've seen that on stocks. We had it to a pretty extreme extent on DRYS, a shipping stock that went from about, $2-3 a share to over 115, and it was in the course of like 3 days. But we've seen it on a lot of different stocks over the years. So no news. Technical can work. It is a good idea to maybe check to see whether or not the stock has a high level of short interest. So whether or not that column has been added to our scanners by the time you're looking at or watching this, I won't know, I suppose, at this point. Hopefully it will be. But you could also go to a website like FinViz and search the stock, as I think I showed you last week. So GME right now, for instance, on FinViz is showing 121% short interest. So that's this website right here, and then the short interest is 121% right there, short float. So, if we did pull up the stock and we notice there's really no news on it, but it does have high level of short interest, okay, then that creates a little bit of context around what might be starting to, be part of this move. We never know what initially causes the breakout. Again, just to reiterate, I'll never buy a stock that's not moving at all. If a stock is not moving and it's not up, I don't buy it. I only jump on things that are already starting to move. So I never know what triggers something to start moving, whether it's someone with deep pockets that placed 100,000 share or 1 million share market order, covering a short position or just going long, or it's, you just never know. For all I know, it could be that one of these penny stock newsletters did email the stock out to a list of 500,000 people, and it some of those people bought it and now it's popped up, and so that could create risk. And but when we don't know that there's an actual news source, we just always have to be a little bit cautious, but it doesn't mean we can't see a big move. So no news, technical breakout, whether it's a short squeeze or just a bounce off the low, a stock that's been beaten up for a long time could become a swing trade and we could see a move back up. Now, the first type of official news would be earnings. And this is very common, as you would imagine. Obviously, companies put out earnings once a quarter. So 10,000 stocks out there times earnings every quarter. We're going to see a lot of earnings headlines. A lot of them are non-events. They're in line with what analysts were expecting, in line with predictions. They don't really generate a whole lot of activity for the stock. But then there are some that are a big surprise, whether it's to the upside or the downside. And as a result of that, we do get some big moves. So when a stock announces their quarterly or annual earnings reports, it can be a big deal, especially if the results are much higher. There's a website called Earnings Whisperer, which I've never felt that it was necessary to subscribe to. I think that's the name of it. Let's see, Earnings Whisperer. I don't know if it's Whisperer or Whispers, Earning Whispers. But this is a website that has been around for forever. But in any case, they give you kind of like up and coming earnings announcements and stuff like that. They run ads on their website, as you can see here. That's an ad. But I don't. It's not my strategy to try to guess what a stock is going to do for earnings. If you're trying to guess, that's gambling. I mean, again, unless you know, and then that's called insider trading. So neither is a good thing. And so we're not going to try to gamble, and probably none of us have any inside information anyways. So essentially trying to guess what a company is going to report for earnings and take a position on that, the high likelihood is the earnings are a non-event. They could be great. They could be terrible. Or they could be just sort of mediocre one way or the other. It's not worth it. So Earnings Whisperer is kind of for trying to, take a trade to anticipate what the earnings will be, but I don't do that. Now, Ryan, good point. I would say that, I'm not an insider at Etsy.com. At this point, my wife worked there, but that was many years ago now. So I would say that I would have a strong inclination that I think that they will beat their earnings expectation for this last quarter, given, as a result of the pandemic, a high degree of people shopping online and things like that. So you could certainly do that, but that's not going to be the basis for a day trading strategy because the risk is a little too high. As a day trader, it's just going to be a lot safer for us to wait for that earnings announcement to come out. Because what if it is a big miss? All of a sudden, you could be talking about a 10, 15% loss on a trade, and that's not going to get you your 10 cents a day. So let's get back to kind of that basic goal. If our goal is 10 cents per share per day, it's going to be a lot, I think, easier. Again, easy is relative, but it's going to be easier to try to get that focusing on what's happening today than trying to anticipate what's going to happen a couple days out or weeks out. So earnings that are a big beat or a big miss will bring in high relative volume. So as a long bias trader, I'll focus on the big wins. Short bias trader, you could focus on the big misses if you wanted. You can certainly do this on large caps as well as small caps. Large cap stocks like Netflix and Amazon, you have a lot of people watching them right around earnings. Day trade, those would be the only days we would probably really want to be day trading those types of stocks. But trading large caps is not my focus because it's not really a good small account strategy. But you can trade earnings really on stocks in any area of the market. Also take note of the fact that earnings could be read as bad in the sense that the company is losing money. But if they're losing substantially less than they were last year, investors could read that as positive because they're turning things around. So, take that with a grain of salt, that sometimes the way you might read it, you would say this is bad, they're losing money. But unless you're fully up to speed on the last several quarterly earnings for that company and what's normal for them and what the expectations were, it could be very difficult to really interpret it and know with certainty. The next catalyst that is probably the next most common is FDA and clinical trial announcements. So many pharmaceutical companies out there, and of course the reason there's so many out there is because they need investors to essentially invest in them to help cover the cost of their research and development because they don't operate at a profit. So it allows the general public to put in their hat for some of these miracle cures that some of these companies are working on, some of which are, will be potentially life-changing when they achieve them, and if they do. And so anyways, FDA clinical trial results, these can all be a big, big deal. A stock that we recently had, it was GLSI, I believe. GLSI, was that the one? They had a cancer, was it breast cancer? Let me just double check. I think it was GLSI. Can someone correct me? Yes. So they had a headline here of a breast cancer trial that they were conducting, and I don't have the headline in front of me right now. Let's see. Quote GLSI. Let me see if I can pull it up over here. So it was great, sounded like a great catalyst, great headline. Where was this? So what day was this? This was back on December 9th. Okay, so we gotta go back a little ways. All right, so December 9th. Okay, so this catalyst here, and so we, at Warrior Trading, if you go to warriortrading.com/quote, and then any stock, you can pull up the quotes on it, and then the news. So Greenwich, or Greenwich, depending on where you live, Life Sciences announces poster presentation of 5-year data for phase 2 clinical trial showing 0% reoccurrence of breast cancer. That's a big deal. The market received this very positively. Reoccurrence affects 1 in 8 women. Approximately 50% with reoccurring cancer do not respond to these 2 drugs. And so anyways, the market responded very favorably to that, and the stock squeezed from $20 to about $160 a share in one day. So, that's the type of catalyst that is a good one, and we can usually feel pretty good about buying into. Not a lot of concern about halt pending, the exchange asking for more information with such a clear catalyst, but a risk of perhaps a secondary offering. So we could pull up GLSI when it starts getting a little bit more expensive, and then saying, well, do we have, an S3, a shelf registration? And I don't recall seeing one, and it doesn't look like they have one here. They have the S1, but not any S3. So let's see what this is, though. So offering 660,000 shares, but this is a 424B. So anyways, it does look like they do have something going on there. So in any case, but on the day of, some nice action. So that's a great example of that biotech type of catalyst. Positive FDA announcements, company getting fast track designation. These can be positive. Sometimes we see in the biomedical space patents, and whether it's a patent on a medical device or something like that, those don't always seem to play out as well. A patent registration as a true, anyone, I guess, suppose could get a patent. So number 4, news of mergers and buyouts. So the buyout that I just showed you a moment ago on VIE at $53 a share, perfect example of a buyout. We will see them from time to time, and these are not a catalyst that we would ever trade. A merger can be a little tricky. If a merger has all of the details of the price, like with a buyout, the price is right here. It's to buy at $53 a share. And sometimes it's a merger at $53 a share. Other times it's a merger that's sort of a complex, the shareholders are going to get X number of shares of the new company plus this much cash. And so initially there can be some volatility in the price as people are like, well, wait a second, what number does that actually equal? But usually mergers are not my favorite catalyst because they're so similar to a buyout. If it's that this stock that is up on the Gap scanner has announced that they're doing a merger of a subsidiary, that could be okay. If they're announcing that they're merging a new company into them, that could be okay. If they're merging out, that's obviously going to be a buyout scenario, and the price is to be determined. There have been times where a stock that has a buyout headline will then have a headline a week or two later that they got a second offer, it's a bidding war. but that's pretty rare. And usually when that type of news hits, the high frequency trading algorithms just rip the stock right up to that next price, and there's no real trade on it anyways. So generally mergers and buyouts are not going to be strong catalysts. This is the clear buyout chart. The fifth type of news, stock splits or reverse splits. So we've already gone through what this is. A traditional stock split, like when Apple climbed to 700 and then did the 7-to-1 split, you understand how this changes the shares. This is just here for, I suppose, the PDF for notes and for a reminder. But the float has increased, as you know. The number of shares you are holding has gone up by the same multiple of the split. That by itself is not typically a catalyst, although in the case of Tesla, we were mindful that the fact that this was a very popular stock, kind of has a cult following, if you will, and that it's now going to be more affordable for the Robinhood, retail trader. This was the split here. The news of the split was a week earlier, and it almost rallied 100% on the news of the split. People were so excited. On the split, it then sold, it popped, I guess, and then it sold off for a few days before consolidating into this breakout in November up here to where we are now. And now it's almost time for another split. So if they announce another split, this will probably go right to $1,000. The split just has that effect of making the stock more affordable, and then therefore you have more people that will buy it. But generally, that's a little unusual, and since we don't usually day trade stocks like Tesla or the large cap stocks, they're doing traditional splits, we're probably not really going to think too much about that in general. When a company puts out the news of a reverse split, that news usually doesn't do enough to trigger. I mean, again, there's companies putting out news every minute of the day, probably every day of the week and the year. In order for the news to then create either a high frequency trading algorithm to buy the stock and then the stock to be up 5% and be on my scanners, or for actual retail traders who are following that stock closely enough to buy it and then the stock to be on the scanner, it needs to be usually better news. And so, yeah, the reverse split is not a strong enough catalyst by itself. That news that they're going to do a reverse split next week does anything. On the day of the reverse split, we still usually don't see that much action. It's not usually until a few days later that they put out some type of good catalyst, whether it's quarterly earnings or FDA announcements or clinical trial results, that then it comes onto people's radar. Then they notice the very low float. So the first thing they do when they check the gap scanner, whoa, this float's got, 300,000 shares or 3.9 million shares. It's a very low float stock. Okay, it's a recent reverse split. The average daily volume on it's next to nothing. And now you're starting to put together pieces of the puzzle for what could be a nice opportunity. But yeah, reverse splits and traditional splits usually are not a strong catalyst by themselves. Analyst price targets also are not usually a strong catalyst. There's so many analysts out there. An analyst can put a price target on GameStop right now of $1,000, and while some people will say, whoa, okay, this analyst has this price target, that alone is probably not going to do a lot. And on a stock that's not being watched by anyone, that alone probably would do almost nothing. So usually price targets are not significant. However, when a stock like GME is already up a lot, sometimes those price targets can kind of be like fanning the fire. It could just be like these little kind of like, just a little dab of fuel is all it needs to just kind of open it up to the next level. So when a stock is already in this state of being parabolic on a daily chart, like Tesla or like GME, of course, to a bigger extent, sometimes little price target increases or, new buy ratings or, just little things like that, little headlines. Maybe a headline that the CEO has bought another 50,000 shares of stock, a Form 4 filing, which typically might not be enough, is like enough for people to be like, okay, here's a little bit more. Activist investors taking positions are almost always significant. There aren't a lot of them out there that are really considered to have a lot of weight behind their name and their capital, their firm. So the ones that we would look at closely would be Bill Ackman, Carl Icahn, certainly Warren Buffett and Berkshire Hathaway. Let's see. You wouldn't consider Jim Cramer's not an activist investor. Some people might follow some of his trades, but not to. And he will talk about stocks that he likes on his TV show. So sometimes you'll see and hear people say, "Oh, this stock was on Kramer last night," but that's usually very short-lived. David Einhorn is another pretty big investor. Let's see. There's a website called Guru Focus, which I had a subscription to at one point, but then found it to not really be helpful. This is it over here. It gives you it talks about stocks owned by different investors, but again, to be honest, I really didn't find this to be helpful in my trading. Carl Icahn, George Soros, David Tepper, Bill Ackman, so Charlie Munger, Bill Gates. I don't know about Bill Gates, but so you can see a few others up there. But so the thing is, when I subscribed to that at the time, I kind of was like, okay, if all the hedge funds are all buying one stock, maybe I should go in, on it too, right? That's a good theory. So at the time, OXY was the one that everyone, this had the most hedge fund investors, and this was around December of 2019, because I was like, all right, you know what? Make 2020 the year that you focus on, being kind of a long-term investor. And so I took a couple trades on OXY. I lost like 20 grand on it. And I was like, all right, so much for being a long-term investor. This thing's back down, like $7 a share. I guess my losses aren't that bad compared to billionaires who have lost billions on it. But yeah, I kind of was like, you know what, man? You just focus on what you're good at, which is day trading, trying to just kind of follow these investors. I mean, it's the same thing with GME. The Melvin Capital, who was short GME, the sort of rumor on the street is because that was a very respected, some of the folks that ran that firm were very well respected. A lot of other hedge funds would just follow what they were doing. So as a result, you kind of have this same kind of, crowd mentality, mob mentality among the big funds. When one goes in, they all go in. So when one wins, they all win. When one loses, they all lose, if they have that approach. And that's just not a good path for making your 10 cents a day, which again, I recognize maybe is a low goal to start, but at the same time, 10 cents a day with 100 shares is $10. Once you can confidently do that before commissions and not worry about commissions and scale it up to 500 and 1,000 shares, you're talking about a nice 100, 200 a day, scaling up. And as you get better, you will have the confidence to start holding some of those trades a little longer. So anyways, activist investors can be significant, but I don't try to really follow them. And I certainly don't try to just hold because they're in forever. I still day trade it following the same rules of, quick entries, quick exits, and the strategies and patterns that we'll talk about more as we get into the classes. Yes, Elon Musk, he certainly has a loyal following. When he tweets about stocks, they, seem to respond to, his sentiment, whether it's positive or negative. So yeah, but a lot of times those can be short-lived. But again, on a stock like GameStop, it can be fueling the fire. So it can. I just don't think it's helpful, for instance, though, to be following like Guru Focus and also like following the Twitter of all of these people's tweets, and you just start to get this major kind of your focus is dispersed so far that it can be hard to focus on doing what you're good at. And you don't want to be blindly following by any means, obviously, me or anyone else. But it's important to know if this is the catalyst, this is what's creating the opportunity, that there may be an opportunity that's present. But again, it's just measuring the risk and reward in that and trying to focus on what you do best. So I don't subscribe to any of those news services. I don't use Twitter. I just don't care about that stuff. I usually will hear about it because of the feed that we have in our chat room. And just people will mention, if there's a catalyst. I just kind of let other people do that for me. So if someone else doesn't mind being distracted and they want to kind of drop it in there, I'll notice it. But yeah, that's it. 8 new orders, contracts, and deals and partnerships. So, when a company has, perhaps a contract from the government, a defense contract or something like that, we know that, the government will spend crazy amounts of money on defense contracts. So those can sometimes be good catalysts for momentum. but contracts, not just government contracts from a big customer. So, Digital Ally, the maker of the body cameras, gets a big contract from, a city police department to outfit every police officer with their body cameras. It's a, multi-million dollar order. That could be a game changer for that company. I mean, that could effectively change that company's profits for that next quarter. So as people anticipate that, they start, jumping in. Sometimes we see the same headlines again and again. A company gets a $10 million new order and it stops becoming something people trade. Recycling old headlines is a little trick that sometimes it seems like companies use to try to keep their company of interest, but recycling those old headlines is very short-lived. Reverse splits can also be considered a headline, but again, to a much lesser extent. Partnerships, perhaps mergers, those could be considered headlines, but not in as significant a way. All right. Secondary offerings. This is typically not the type of headline we like to see as a long bias trader. However, an instance where it is a good headline would be if the stock is trading, let's say GameStop right now, let's say the company halts trading and we have news that they're doing a secondary offering. Immediately, everyone's going to be like, oh God, what's the price going to be? And the price comes out at $300 a share. It spikes up to 300 and keeps going. What you thought was going to be terrible was positive. It's not common. But when a secondary offering is priced either above the current price or just below it, that's very bullish because the scary thing that people were afraid of happening has happened and it isn't that bad. It's still diluting the value of the stock because they're still selling more shares onto the open market at that price, but it's certainly not nearly as bad as a low offering. So sometimes an offering can be a positive, but that's probably 1 out of every 10, maybe even less than that. Because initially the dilution and the price being low is the problem. So this is the DRYS chart and a stock that just had this history of popping, short squeeze, and then offerings. And it's just a cycle of reverse splits. And then this was another big short squeeze and then, back down. So, you look at this on the chart and it looks like that went from, $10 to 800. It was really more like $1 to 100 or something like that. But then later they did an 8 to 1 or 10 to 1 reverse split. And so when they do those reverse splits, what it effectively does, because it moves the stock price up, right? So a 20 to 1 reverse split at 20 cents moves the stock up to $4 a share. So then all of a sudden the chart going all the way back has to move back up also. So that's why you'll see these charts on stocks that have done reverse splits where you're like, oh my God, are you for real that the all-time high on this stock was $80,000 a share? Let's just say, for instance. And the answer is no, but through a period of reverse splits, this appears that it at one time had a high of $1,000. The problem is if you don't adjust the chart for the reverse split, you can't see how far down it's come. You can't see where the actual resistance levels are. So you have to adjust the chart, but it does create confusion for some people who are like not understanding, when was the stock at $1,000 a share? But it's just, again, because of the way reverse splits allow it to go lower and lower and lower. And so then they have to adjust the historical price action up, because the stock can never go below 0. So that's essentially what's happening there. And again, just a brief headline there of a secondary offering announced pre-market and the stock drops from 40 down to 28 bucks. That was a nasty drop. And this was one that was looking really good. This was BPTH, but then all of a sudden that news and right back down. So that marked the top of this move right in here, essentially. I believe it was this move right in here. And actually, I think I told you about this, but there's a hedge fund that lost like $15 billion or something. Sorry, $15 million shorting the stock with 800,000 shares into this big squeeze up. No news to account for the move. They were bullish or bearish. They were very confident that it was just going to come back down, and they got squeezed. So another secondary offering there. Again, these are not usually positive headlines. And number 10, trading IPOs. The actual day of the initial public offering, these can be tricky. I will trade them, especially when it's a popular IPO like Uber or Lyft or Alibaba, but Facebook, Twitter, stuff like that. But no-name IPOs usually I wouldn't trade, but occasionally a no-name IPO in a market where we're seeing that cycle where IPOs are really hot because one did something crazy, we will start to see that they IPO better, and we do get some nice opportunities. We saw that actually just recently. Let's see. Can someone call out a couple of the ones from December? WNW was a really nice one. This is a Chinese IPO. Goes from $7 to 160. We had, I'm trying to remember the names. Wish was an IPO in December, or a little further back actually, but well, no, it was December. So initial IPO kind of failed, and then this was a recent IPO breakout. GLSI, Airbnb, Woof. Yeah, Woof was a good one. What was the one that Joseph traded? Joseph did really well on one. Was it WNW? Maybe that was it. Woof, really nice IPO from 26 up to 31. QS. But anyways, so we do sometimes find that trading IPOs or recent IPO breakouts can be an opportunity, but it's one that can be very risky because the moment it starts trading could just be, the volume is so crazy. And then what I would add here as just to, so that's the Snapchat IPO. So that was a good one. And I'm just going to add another slide here. Let me just hide my speaker notes here. So let's see. So that was Snap. And then I'm going to just duplicate this. And I'm going to add one more slide here of 11 hot sector. So sector strength, Chinese stocks, recent IPO stocks, recent reverse split stocks, specific headlines, or I'll just say COVID, Ebola, police body cameras, etc. So those types of stocks. We'll just align it like this. So, you know, as I mentioned earlier, this is definitely worth having as its own section here, the hot sector. So I'll just go and add it here, 11 hot sector. Because when we do see that sector strength, you know, it definitely provides an opportunity. All right, so we'll jump back in here to full screen. Oops, back to full screen. All right. So, and then step 3 is identifying strong daily charts. So again, as we began policy body cameras, I'll fix that, thanks. So police body cameras. So again, as we began chapter 3, we were talking about the fact that stock selection can be a second form of risk management. Ultimately, we want to do everything possible to reduce our risk as traders. So by choosing stronger stocks, by being more careful and cautious on trading stocks that don't have a clear catalyst or that pose higher risk of doing either secondary offerings or getting halted for, you know, by the exchange, we can reduce our risk a little bit more, avoiding OTC stocks and penny stocks. And then the next level of reducing risk in trading is not just understanding risk management from profit loss, you know, ratio and percentage of success, not trading real money until you're ready, not just choosing the right stocks, but then identifying the right entry points. So we're going to continue in chapter 4 with identifying strong daily charts, because a strong daily chart can help kind of lay the groundwork for what could potentially be a very strong intraday opportunity. And then we'll get into intraday charts in chapter 5. In chapter 6, we're going to get into a little bit more detail and depth in level 2 and tape reading. And then we're going to start getting into chapter 7, 8, 9, 10 on real strategy development. So let's, from here, move forward into chapter 4. I encourage you guys to continue, who are watching on the LMS, the Learning Management software, to do your quizzes. Make sure if anything is kind of falling through the cracks that you come back, rewatch that section of the class. And certainly in chapter 3, being in the chat room as often as you're able to will help you, because just of the fact that every single day we're going through that process of building a watch list. Was there a step 4? Yeah, and step 4, identifying potential entries. We'll be discussing that as we get further into the classes. So your process each day of building a watch list will essentially, in my opinion, be starting with the gap scanner. So opening gap scanner and looking at the top gappers, looking at the float, then price, then volume, the percentage of the gap, then looking at the chart. Once you're looking at the chart, you ask yourself whether or not the stock is even good enough to look at the catalyst and try to dig deeper. If it's good enough to look at the catalyst, then go and dig deeper. look at the catalyst, understand what type of catalyst it is, what the strength is, perhaps do a little research to see if they have an active shelf registration if you feel so inclined, and then begin breaking down the daily chart and the intraday chart for potential entries and potential resistance levels. All right, so with that, we're going to get into chapter 4. So we'll continue on from here.